They are telling you property taxes will keep rising in 2026. They are right. Illinois seniors are losing homes over $6,000 plus annual bills. Oregon homeowners are paying $4,500 plus, and it keeps climbing. California retirees are being crushed by Prop 13 workarounds, but here is what the mainstream media isn't telling you. A new federal tax relief package, often touted as the biggest senior tax relief in 40 years, has introduced a $6,000 deduction per person, or $12,000 for couples. The question is, will it actually help, or will high-tax state property levies just eat it alive? Before we break down exactly who wins, who loses, and whether this federal relief actually saves seniors from property tax hell, welcome to Tax Hack Pro. We are covering the tax stories that directly affect your retirement, while mainstream outlets run interference for politicians raising your bills. If you want analysis that puts your wallet first, hit that subscribe button and like this video. Now let's examine whether this new deduction is real relief or just a band-aid on a state tax hemorrhage. Here is the federal relief that just kicked in, and the numbers are substantial. The legislation created a brand new $6,000 deduction for every person aged 65 and older. If you are married, that is $12,000 total. This is on top of the existing extra standard deduction seniors already get. And here is the critical part. It is available whether you itemize deductions or take the standard deduction. Effective immediately for the 2025 to 2028 tax years, income limits apply. They are set at $75,000 for singles and $150,000 for couples. Then it phases out. For about 90% of American retirees, this deduction will reduce their federal income tax to near zero or completely eliminate it. Let me show you the math on what this actually means. The average Social Security benefit is about $24,000 annually. Up to 85% of that, roughly $20,400, can be federally taxable under current law. With this new $6,000 individual deduction, that taxable Social Security essentially disappears for most retirees. A single senior gets $23,750 total in new deductions. A married couple gets $47,500. That covers average Social Security benefits completely and shields significant additional income from federal taxation. That sounds great, right? Federal tax relief for seniors who desperately need it. But here is where the reality of high-tax states crashes into federal generosity. Share this video, because what I am about to show you exposes why location matters more than federal tax policy. Now let's talk about the property tax nightmare this federal deduction is supposed to help with. Illinois leads the disaster. The average property tax bill just hit $6,575 in 2025, the second highest in the entire nation. But that is just the average. In Cook County suburbs, bills of $7,000, $8,000, or $9,000 annually are common. Some areas are pushing $12,000 to $15,000. Here is what that means for a typical Illinois senior couple. They are on a fixed income of $50,000 combined from Social Security and a modest pension. Their property tax bill is $8,000 annually. That is 16% of their gross income gone, just for the privilege of staying in a home they already own. The new $12,000 federal deduction saves them maybe $1,200 to $1,500 in federal income tax. Sounds good until you realize their property tax just went up by $400 this year alone. The net benefit is maybe $800 to $1,100. That is real money, don't get me wrong, but it doesn't solve the underlying crisis. Oregon isn't much better. The average effective property tax rate is 1.07%. That doesn't sound terrible until you see home values. A $400,000 home in the Portland metro area means $4,280 in annual property tax. The Eugene area sees similar pain. And Oregon has aggressive property tax assessment increases built into their system. Oregon also taxes retirement income at rates up to 9.9%. So while the federal deduction helps with federal taxes, Oregon State is still taking its cut from your pension, your $401,000 withdrawals, and your IRA distributions. The federal relief doesn't touch that. California is its own special nightmare. Yes, Prop 13 caps assessment increases at 2% annually. Sounds protective until you realize new retirees buying into California face property taxes based on current purchase prices. An $800,000 home in San Diego means $8,000 to $10,000 annually, and California's income tax hits 13.3%, the highest in the nation. Comment below what state you are in and what your actual property tax bill is. I want to hear from real seniors facing real numbers. Let me show you the actual math for an Illinois couple, because this is where theory meets brutal reality. Meet Tom and Linda, both 67, retired in a Chicago suburb. Their situation: combined Social Security of $42,000, pension income of $18,000, total $60,000 annually. Their property tax bill is $7,200. Illinois state income tax at 4.95% is about $2,970. Total state and local taxes: $10,170. That is 17% of their income. Under old federal rules, they owed maybe $1,800 in federal income tax. With the new $12,000 senior deduction, their federal tax drops to approximately $300. That is $1,500 in federal savings. Sounds great until you realize their property tax increased $350 this year. Their homeowner's insurance jumped $280. Utility costs are up $400. Healthcare premiums rose $600. The net result: the $1,500 federal savings got completely consumed by increased costs, and they are actually worse off than last year despite tax relief. That is the tax trap. The federal government gives relief. State and local government takes it right back through property taxes, fees, assessments, and costs they control. Now let's compare to low-tax states, because this is where the difference becomes undeniable. Take a Florida couple, same age, same income of $60,000 annually. Property tax in the Tampa area on a comparable home is $2,400. Florida state income tax is zero. Federal tax with the new deduction is the same $300 as the Illinois couple. Total tax burden: $2,700 versus the Illinois couple's $10,470. That is a $7,770 difference every single year. Over a 20-year retirement, that is a $155,400 difference. That is the equity in your home. That is your legacy to your kids. That is real money. A Tennessee couple pays property tax of maybe $1,800. State income tax is zero. A Texas couple pays property tax of $3,500 to $4,000. State income tax is zero. The pattern is obvious. The federal deduction helps everyone equally, but high-tax state taxes immediately consume that benefit while residents in other states actually keep it. Drop a comment. Are you seriously considering leaving your state because of property taxes? Here is where the senior deduction actually makes the biggest impact. Middle-income retirees in low-tax states get the full benefit. You are in Tennessee with $65,000 income, no state income tax, modest property taxes. The deduction drops your federal tax from maybe $2,000 to $200. You actually pocket $1,800 in savings that stays saved because your state isn't raising property taxes 5 to 7% annually to feed government pension obligations. Lower-income seniors nationwide see minimal benefit because they already paid little or no federal tax. If you are on $30,000 Social Security alone, you probably weren't paying federal income tax anyway. The deduction doesn't help you because you had no tax liability to reduce. Higher-income seniors phase out of the benefit. If you are a couple making over $150,000, the deduction phases out completely. You get nothing. Meanwhile, you're still paying those massive Illinois or Oregon property taxes with zero federal relief. So who actually wins from this deduction? Middle-income seniors in states with better fiscal policies. They get the federal relief, and they aren't getting crushed by property tax increases that erase the benefit. Now, here is the part that should make every senior in a high-tax state furious. The federal government just gave you tax relief. Your state response: Illinois property tax levies increased billions under recent administrations. Oregon continues aggressive property tax assessments. California keeps finding creative ways around limits. They see federal relief as an opportunity. Oh, seniors just got a $1,500 federal tax break. Perfect. We can raise property taxes another $400 and they will still feel like they are ahead. That is literally how budgeting works in these states. Federal government creates relief. State government captures it. You never actually benefit. It goes straight from the tax cut into state spending priorities. You are just the pass-through. Share this everywhere because seniors need to understand this wealth transfer happening right under their noses. Let me show you what this looks like over a retirement timeline. An Illinois couple aged 65 now, planning to stay in their home until 85. Current property tax is $7,200. Historical Illinois property tax growth rate is 3 to 4% annually. In 20 years, that $7,200 becomes $12,500 to $14,000 annually. The deduction expires in 2028, so you get 4 years of federal relief, then it is gone unless Congress extends it. Meanwhile, property tax increases continue forever. Years 5 through 20 of retirement, you are paying constantly increasing property taxes with zero federal relief. Total property taxes paid over 20 years in Illinois. Approximately $180,000 to $200,000. Federal relief over 4 years, maybe $6,000 total. That is 3% relief on a $200,000 liability. Same couple in Florida. Total property taxes over 20 years, maybe $55,000 to $65,000. Federal relief, same $6,000. But they are already saving $135,000 on property taxes alone by living in Florida instead of Illinois. That is before you factor in state income tax. Higher sales taxes, higher fees, higher everything. The wealth destruction of staying in a high-tax state is staggering, even with federal tax relief. So here is the uncomfortable truth nobody wants to say out loud. The senior deduction is real relief. It is meaningful for millions of retirees. It is the biggest senior-focused tax break in decades, but it cannot overcome state tax policies designed to extract maximum revenue from fixed-income residents. If you are a senior in Illinois paying $7,000 or more in property taxes, this deduction helps, but it doesn't solve your problem. Your problem is state and local government treating you like an ATM machine. Federal relief is a Band-Aid on a gunshot wound. If you are a senior in Oregon facing property taxes and state income taxes on your retirement distributions, this deduction helps federally. But Oregon still takes its share, and there is nothing the federal government can do about that. If you are in California, same story. Federal relief comes in, state keeps crushing you. The only real solution, leave. Move to a state that respects retirees instead of exploiting them. Florida, Texas, Tennessee, Nevada, Wyoming, South Dakota. States with no income tax and reasonable property taxes. Comment below. Is this deduction enough to keep you in your current state, or are you still planning to leave? Here is what you need to do right now with this information. First, understand your actual tax situation. The deduction helps with federal income tax only. It does nothing for property taxes, state income taxes, sales taxes, fees, or any other state and local extractions. Second, calculate your true retirement tax burden. Add up property tax plus state income tax plus sales tax estimates plus all fees. Compare that to what you would pay in a no-income tax state with lower property taxes. The difference will shock you. Third, seriously evaluate relocation. I'm not saying everyone should leave Illinois or Oregon, but you need to honestly assess whether staying makes financial sense. If the tax differential is $6,000 to $8,000 annually, that is $120,000 to $160,000 over a 20-year retirement. That is real wealth being transferred from you to state government. Fourth, plan for 2029. This deduction expires after 2028. Unless Congress extends it, which is possible but not guaranteed, you will lose this federal relief. Meanwhile, state property taxes keep climbing. Your tax burden could actually be higher in 2029 than it is now, even after having the deduction for 4 years. If this analysis showed you the real math mainstream media won't explain, subscribe to Tax Hack Pro and turn on notifications. We are tracking tax policy that actually affects your retirement decisions. Share this with every senior you know who needs to understand why location matters more than federal relief. Comment your state and whether you are staying or leaving. I want to hear from retirees making these decisions right now. Thanks for watching Tax Hack Pro. We will keep breaking down policy that impacts your wallet while others spin narratives. See you in the next one.